Central banks are secretly printing money, and it's messing with the value of your savings. Quantitative easing, a post-2008 policy, is the economic policy that causes the dollar in your pocket to secretly lose its purchasing power without you even knowing it happened. Learn how it works, and whether this is a real economic tool or a secret form of currency devaluation. So, why do different currencies have different values? It all comes down to supply and demand in the global economy. Think of it like this. If lots of people want to buy US dollars, the dollar's value goes up. If people are selling dollars, the value goes down. But what makes people want to buy or sell a particular currency? One big factor is a country's economy. If a country's economy is doing well, meaning its GDP is growing, unemployment is low, and businesses are thriving, people from other countries will want to invest there. To invest, they need to buy that country's currency, which increases its demand and value. Strong economic growth is a good sign. A recession would not be a good sign. Another important factor is inflation. Inflation is the rate at which prices for goods and services are rising. If a country has high inflation, its currency tends to lose value because people can buy less with it. Central banks try to control inflation through monetary policy, mainly by adjusting interest rates. Higher interest rates can attract foreign investment, boosting the currency's value. The central bank is always looking to achieve price stability. Trade also plays a huge role. If a country exports more than it imports, a trade surplus, there's more demand for its currency because other countries need it to buy its goods and services. On the other hand, if a country imports more than it exports, a trade deficit, its currency might weaken. Trade balance is key. Exports and imports should be looked at accordingly. Government policies also affect currency values. Fiscal policy, government spending and taxation, and regulations can influence investor confidence and economic stability. Political risk, such as instability or corruption, can also scare away investors and weaken a currency. A good regulatory environment is important. Policy uncertainty is not good for market sentiment. Sometimes currency values are affected by speculation. If investors believe a currency will go up in value, they'll buy it, driving up its price. This can create volatility and risk in the foreign exchange market. Speculation is not always based on fundamentals and can cause sharp fluctuations. Also, the value of currencies are based on if they are pegged exchange rate, floating exchange rate, or managed float. Geopolitics and global events can also have a significant impact. Wars, conflicts, or even major political announcements can create uncertainty and affect investor sentiment, leading to currency fluctuations. In times of crisis, some currencies are seen as safe havens, and their value tends to increase. Understanding these factors is crucial for anyone involved in international business, investment, or even travel. Currency fluctuations can significantly impact profits, costs, and purchasing power. However, our exploration leaves some stones unturned. How exactly do psychological factors and herd behavior in the forex market influence short-term currency swings? What role do high-frequency trading algorithms play in exacerbating currency volatility? These questions remain partially unanswered and offer fertile ground for future investigation. This topic also gets pretty interconnected and interdependent across many different aspects of business and the global economy. If you found this video helpful, please like, share, and subscribe for more insights into the world of finance and economics.